Hi, everyone. I would like to thank you all for joining us today. I would also like to welcome you on behalf of the Junior Economic Club of Chicago. The JEC is a student run nonprofit organization that exposes high school students to the fields of business, economics, finance, and entrepreneurship. We connect like minded high school students from all across Chicago through our workshops, forums, and events. Our members represent over 25 schools across the city of Chicago. We will begin the presentation in a few moments, but first, I would like to introduce our accomplished panelists from the Chicago branch of the Credit Abuse Resistance Education, or CARE. CARE educates high school and college students on the responsible use of credit and other fundamentals of financial literacy, as well as the potential consequences of poor money management and credit card abuse. Today, our speakers include Ms. Bridget Degay, who is a bankruptcy and restructuring attorney. She received her Bachelor of Arts degree from Duke University and her Juris Doctor degree from Harvard Law School. She also served as a bankruptcy law clerk at the U.S. Bankruptcy Court of the Northern District of Illinois. Welcome, Ms. Degay. Thank you for joining us. Next, we have Mr. Raj Prasad. He is a data strategy executive with TransUnion. He works in various roles, including IT strategy planning and complex project delivery responsibilities. He also finds innovative solutions to identify new uses of existing data assets to maximize the value potential using big data technologies. Thank you for joining us, Mr. Prasad, and welcome. Lastly, we have Mr. Harold Israel, who is a partner at Levenfield Pearlstein. He helps achieve creative solutions for companies facing financial difficulties by achieving unexpected results in a practical, responsive, and effective manner in workouts. He also assists companies seeking to expand their business base by buying financially troubled companies and assisting creditors in recovering their unpaid claims. Welcome, Mr. Israel, and thank you for joining us. To kick off our presentation, we will have Ms. Bridget Degay explaining student loans.
And unfortunately students make. So the three main takeaways, I just wanted to kind of summarize what the three major points are to take away from the student loans portion of the presentation. And those three main takeaways are: student loans should be your last option to finance your education. You should choose federal over private loans. And we're going to talk a little bit more about what the differences are as I go through the presentation. And then the last takeaway is, when you take out, or if you take out any student loans, you should really understand the loan terms, and you should try not to go into default. So the first thing, when you're going through the process of financing your college education, I think of it as a three-step process. The first step is researching all the costs of the schools that you're considering and that you're applying to, and looking for schools that offer scholarships. So you want to look at colleges that are going to offer you either partial, full scholarships or some kind of scholarship money. In addition to that, you want to look outside of the schools that you're applying to and see if your state, or if there are any other national scholarships that you can apply to that'll help you finance your college education. The second step of it is applying for aid from the federal government. And you do this by filling out the FAFSA form, which we're going to get into in a little bit of time. And also finding out if the colleges that you're applying to require you to submit more financial documents to prove that you need aid, or to help them determine how much aid you need. So the final step of that is getting an aid letter from the schools that you're accepted to. This aid letter will basically tell you what grants and loans you're eligible for. So what's the FAFSA? The FAFSA is a free application for federal student aid. You have to complete it to get grants and loan. It's available October 1st of your senior year. And you basically have to go online, create an account. You need your financial information if you've been working or if you have bank accounts. But you also need your parents or your guardian's financial information. So this is going to be any tax return, any retirement accounts that they need. And you also need information from a parent who doesn't live with you, because the college and the government has to get a full picture of what your financial situation is. So the third step is when you get the award letter. Each college is going to send you a financial award letter that's going to list all the grants, the work study, and the scholarships, as well as the federal loans that you're eligible for. It's really important for you to review the award letter, review it, understand what's free money, understand what you have to repay, look to see if the full cost of the college is accounted for. So that's going to include something like housing. If you don't understand, you should definitely call the financial aid office and have them walk you through the letter. And it's really important for you to ask them questions such as if you have to reapply for any grants or any scholarships each year, and to ask them if whether your GPA impacts any grants or scholarships that you receive. I had a friend once who got a scholarship for law school, but he learned that the scholarship was contingent, or when they initially offered it to him, it was dependent on his GPA. And he heard through the grapevine that they put all the GPA students in the same section. So that made it more likely that some of the people would be losing their scholarship. So he just made sure to advocate for himself and to ask for the scholarship not to be dependent on his GPA. And the last thing is to really advocate for yourself. If you need more money or if there are certain situations that they didn't take into account, I think it's perfectly reasonable to call the financial aid office and explain to them some of the things that they may not have considered. So the award letter is going to list out work study, which is basically money that you get from the college for a job that you do on campus. It's also going to have scholarships. These don't have to be paid back, nor do federal grants or a state grant, kind of the Illinois Monetary Award Program. The two main takeaways from this portion is if you get work study, remember that your focus is school. So don't get so consumed in doing work study that you forget like why you're in college. And the other main takeaway is don't pay to find scholarships. You know, go online, go to the CARE website and look through our resources. There's actually a list of different sites that you can go to find and apply for scholarships. And then to the main, kind of the main subject of this part, student loans should basically be your last option for financing your college education. Student loans can create a really huge burden for students. As I have here, around a quarter of student loan borrowers are either delinquent or they're in default. And student loans are actually extremely difficult to discharge in bankruptcy. So you want to be wary of student loans. You don't want to take out any more than what you really realistically need to finance your college education. How much should you borrow? This is a really important question. So, you know, I think we're all at this point really aware of the fact that we should be trying to avoid student loans, and student loans are not a really great way to start off. But there may come a situation where it's really likely that you may need to take out some student loans to finance your education. And some of the things that you need to think about, whether your degree has the earning power to pay off your student loans. Are you planning on going to graduate school? And the rule of thumb here is that your total student loan debt shouldn't exceed your first year salary after college or after grad school. So for me personally, when I went to college, I knew that I wanted to go to law school, and I'd read all these stories about how expensive law school was and how people often have to take out really a lot of student loans to go to law school. So I was very, very careful when I was in college. I researched outside scholarships. I did work study. And I really, really tried to take out the minimal amount of debt that I could for undergrad, because that would give me a lot more room when I ended up going to law school. And a really important question to ask yourself is if your target school requires you to take out loans in excess of what you can afford, I think you really need to stop and rethink about going to the school. And so this is part of really thinking about what are some hints of what you want to do after you finish school? How much will that pay after you're done with college? Will taking out a large number of loans put you in a good position, or is that something that you can't afford? So there are two types of student loans. If you remember, one of the main takeaways I had in the beginning was that always choose federal over private loans. So there are federal loans and there are private loans. And the three type of federal loans are the federal plus loans, the federal Stafford subsidized loans, and federal Stafford unsubsidized loans. With the federal plus loans, these are need-based and these are loans that parents take out. With these loans, the borrower has to begin making payments when the loan is dispersed, which is typically when the student is still in school. With the federal Stafford subsidized loans, the government pays interest while you're in school and for 6 months after you leave. With the unsubsidized, you have to begin paying them while you're in school, but you can defer the interest payments until you finish. Why are federal loans preferred over private loans? They have a fixed interest rate. So that means like the interest rate doesn't change and it's usually lower than the interest rate of private loans. Interest is typically deferred while you're in school. There's also a really long cure or grace period. And this basically means that if you fall behind on payments, the lender's not going to consider you in default very quickly. And they're going to give you an opportunity to like get back into good graces. There's also a lot of really student-friendly repayment option, and there are loan forgiveness programs for teachers and if you enter into public service. Now, private loans, on the other hand, these are usually loans that are offered by banks or other financial institution. Your parents have to co-sign. They have floating interest rates. So that means that basically the interest rate depends on credit history, and they can go as high as 25% or 30%, which is extremely high when you compare the typical rate for federal loans. They have immediate payment, and you don't have a right to postpone or extend payments, and there are hair trigger defaults. So the bottom line on private student loans, those should be the last option. So we started off with try to finance your education with everything but loans. But if you have to get loans, try to get federal loans as opposed to getting private loans, and try to max out, which means try to take out the maximum amount of federal loans that you can take out before you consider the private loans option. So what happens if you default? Earlier in the presentation, we talked about student loans and we talked about the number of people who are either in default and what can happen with that. So one really important thing to keep in mind is that you have to repay your student loans whether or not you finish college. That's really, really important. So that means if you don't finish or if you stop halfway, you still have to repay the loans that you've taken out. The lender can sue you. They can garnish your wages. They can take your income tax refunds. You can't renew your professional license. So for attorneys, we have to be barred in different states. And I know for me, for New Jersey, when you're applying to get your professional license, they ask whether your student loans are in good standing. So if you're not in good standing with your student loans, that can actually impact your ability to be licensed in different professions. It's on your credit report, and it makes you ineligible for further financial aid if you need it, if you decide to do another program. So the biggest summary is look for college funding from everything other than student loans. Make sure to fill out your FAFSA early, apply for grants and scholarships, and really, really figure out how much in student loans you can afford. So when you're in high school, you have some inkling about what you potentially want to do when you go to college or after college. You may not be 100% sure, but you have some ideas what you want to do. And researching your career, researching different schools. Even from looking around from the different financial aid websites of different colleges, you can actually input information and you can try to figure out how much aid you would get from that school. You can try to figure out how much it would cost for you to attend that school. So you have to really be proactive in looking at different schools and looking at the aid that they can offer you and trying to make a really good financial decision so that when you graduate college, you're not going to have a lot of student debt. And I think that can be really helpful. I mean, for me, one of the things I was thinking about when I was applying to college is I wanted to study abroad. So that was really important for me, and that was something I researched when I was looking at different schools. And the great thing about Duke actually had a scholarship that you had to apply for, and they would pay for you to study abroad. So that was something that was very, very attractive for me when I was looking at different schools. Another thing that I did was I applied for a lot of scholarships. Surprisingly, a lot of people don't apply for scholarships. And I think part of the reason why they don't do this is because it takes more effort. When I was in law school, I think in Los Angeles, there was a bar association that had an essay scholarship. And all you had to do was write an essay about a certain topic, and they would pick the best essay, and that person would get $5,000. And so I did that. So just putting forth the effort of looking for scholarships, really researching the cost of schools, trying to determine what careers you're interested in and how much that will pay when you're done with college, and making sure that you don't really overburden yourself. I had a friend who wanted to be an actress, and she got into NYU, but going to NYU would have required her to take out $80,000 in loans. And my thought process on that, and eventually her parents' thought process on that, was that was an exorbitant amount of student loans to take out, especially when you're coming out to go into a profession that's not going to immediately pay out. So I think the main takeaways are to really, really be thoughtful in the decisions that you make when you're looking at colleges, and to be aware of the different student loans, and to make sure that you're thinking about future you and not overburdening future you.
Thank you so much for sharing, Ms. Dege. Those are all some super important things we need to put into consideration when thinking about education after high school. Thank you once again. Next, I would like to welcome Mr. Raj Prasad, who will be presenting all about credit score and credit reports.
Thank you, Olivia. Thank you, Bridget, for an excellent presentation. Good morning, everyone else. This is awesome to see all of you taking your time on a Saturday morning to learn about these important things that not many kids really care about, not many students really care about. But the very nature of you caring about these topics itself tells me that you guys are all in good standing, and you care about these topics, whether it's student loans or credit reports, or credit scores and identity theft. So that itself tells me that you guys are all in good standing. So before we go into the credit score, let me talk a little bit about the credit history and how a credit history is created, because understanding the way credit history works will then help us understand the credit score topic. So the question here is how and when a credit history starts is basically, and what things that go into credit history, right? So it starts when you start applying for any kind of credit. Credit can be a credit card, a credit can be a car loan, or a private student loan, or a mortgage, right? So if you have a debit card, that debit card information will not go into the credit history. So anything with the credit, that means somebody is giving you money that you owe at some point, right? It can be credit cards that you owe back in a month time. Car loans typically run, let's say, 3 years, 5 years, 7 years. Mortgages typically run like over a period of 15, 20, 30 years, right? So anytime someone is giving you money and you owe the money back, that's called credit. Debit is something that you are using your own money that's sitting in your bank account. All you're using a debit card, and that debit information does not get into your credit history. Now let's talk about how a credit history works. So to start off, there are 3 big credit reporting companies in this country, and for the most part in the whole world, right? So Equifax, Experian, and TransUnion. And if you heard the introduction, I work for this company called TransUnion. So just wanted to talk about how the credit history works. So let's say you all turn 18. I mean, only when you turn 18, you can apply for credit by yourself. Before that, if you need a credit card, which is probably a good idea to have your parent, guardian, or someone co-sign or co-authorize you for their credit card. But assuming you want to apply for your own credit, when you turn 18, you go apply for credit. And at that time, the creditor, which is the financial institution where you're applying, want to know about your payment history. Like, how responsible are you with credit? That's all they're trying to find out. Before they give you money, whether it is $100 or $100,000, before they give you money, they want to find out how responsible have you been in paying off that debt, right? So they look for the information, and that is called the credit history. So they will come and ask a company like an Equifax or Experian or TransUnion to find out how well they have done. And what we do is we then provide whatever information is there on your credit profile and send it back to that financial institution, who then can decide whether to give this person credit. So there are two decision points. One is, can I give credit? Do I have enough information to trust this person and give this money? And then the second question is, if I trust them, how well do I trust them? And that will decide what's the interest rate that financial institution can charge. So interest rates can vary depending on how good somebody's credit history or credit score is. And based on that, the consumer is either granted or denied the credit. And then once this person gets the credit, let's say they get the credit card, right? So then they start using the credit card at different stores, different places. And every month they get the credit card statement. And then as soon as you pay back your credit card statement, whatever you are owed, and that information will come back to these companies like Equifax, Experian, TransUnion, and that goes in terms of building your credit history. So let's say you get a credit card today, and then you wait for 2 years. And if you see your credit history, you will see, okay, you have a credit card from Capital One, and every month you have been paying off your the money that you due on time. So same way, if you get a mortgage or an auto loan, all the information of how well have you been paying off on time every month, that's all memorialized or maintained in this thing called credit report. So what is a credit report? It basically gives the information, all the information about the summary of all the financial reliability of a consumer, how well they have been paying off. Credit report also has other information like your name, your all the addresses that you have lived on, at the very least, the 3 addresses that you have lived on. It has your date of birth, it has your social security number, your phone number, and then it talks about all the different credit cards or student loans or mortgages or auto loans that you owed. And it tells you, this is the bank it came from, here is the address of the bank, address and the phone number, and then it goes into the details of, for the last X number of years, how well you have been paying on a monthly basis. It'll say on January 2017, you paid on time. February 2017, you paid on time. March 2017, you paid on time. And for some reason, if any one month that someone did not pay it on time, then it'll say, is it a 30 days late to 60 days late or 90 days late? And then it gets into kind of a delinquency process. So all this information is maintained in what we call as a credit report. So typically in these presentations, we equate the credit report to the report card that you receive from your schools. For students like you all, it's very easy to understand what a report card is and what a GPA is, right? So we equate the credit report to a report card where you get all the details of all the different classes that you attended and the grades that you've taken. GPA is kind of the numeric representation of your report card. So you can, as every consumer in this country can get their credit report free every 12 months from each of these 3 bureaus. As we discussed, it's Equifax, Experian, and TransUnion. And if you go into this website called annualcreditreport.com, don't go to any other sites where they talk about free credit reports. There are a lot of scams going on. So remember this site called annualcreditreport.com, where you can go every 12 months and pull a report on Equifax, Experian, and TransUnion. And what we suggest is, maybe every 4 months you go and pull one from, let's say on January 1st, you do from Equifax, On April you can do from Experian, and then September you can, let's say, get from TransUnion. So then you can continue the cycle every year. You can also get Credit Karma. Credit Karma has a good a phone app as well. You can look at your credit report and credit score through Credit Karma as well. That's also free. So what's in a credit score? So we talked about credit report being an adult report card, adult report card, and the credit score being your GPA. And how the GPA is calculated is what this slide is talking about. Basically, on the left side, you see like 5 different factors: payment history, outstanding debt, credit account history, recent inquiries, and type of credit. We'll talk about that in the next slide as well. But so these are the things that go into a credit score. But your age or race or religion, your employment information, none of that will get into your credit score. So that is sometimes people kind of misunderstand, what's in credit and what's not in credit. So this one, you should clearly know that, for example, where you work, how much you make does not, care. We don't care from a credit report or a credit score standpoint. The most important thing that you need to know is the payment history. If there's one piece that you take away from this presentation is make sure that you pay your bills or pay your credit card every month on time in full. And if you can take care of that, you don't have to worry about your adult GPA. You don't have to worry about your credit score. That will take care of itself. So that's the most important thing. And then the other things like outstanding debt, right? So let's say you have a credit card. Make sure that you don't spend or don't touch the ceiling every month. Ideally, if you can limit the spending to, let's say, 20 to 30% of your credit limit, that also will help in having a good credit score. Let's go to the next slide. I think that will help. Yeah. So yeah, this is the key thing, right? So payment history is 35%. So that means 35% of your credit score is calculated based on how well you are paying your credit card on time. And the type of credit used is 10%, which is, again, when I say type of credit, it's either, having credit cards, having auto loans and mortgage, and all the 3 types of them will help improve. But obviously, when you start off, there is, you can't really control that, right? The main thing that you can control in this slide is the payment history, which is 35%, and the outstanding balances, which is the 30% that's on the bottom right side. So those are the 2 things that you have control on. The other 3 are not much, you don't have that much control on, right? But between the 35 and the 30, 65% of your credit score that you do have control on. And the main thing is make sure that you are paying your credit cards on time every month full. Again, same thing, right? Your parents can make a payment for you, but they cannot, not anyone can make a late payment not late. That means if you are late, it is going to be reported by your credit card company to companies like TransUnion, and we are going to keep that in your history, as long as 7 years. I mean, obviously, if there is one time, everyone makes a mistake, right? I have made mistakes in my life, that let's say you're on vacation, you forgot, for some reason, you forgot to pay your credit card on time. You get into the scenario of 30-day delinquency. And as long as it just, once in a while it happened for me, let's say 3 years back. So at that time, I saw a dip in my credit score. But since then, I've been very careful in paying off my credit cards on time. So the credit score starts to improve. It takes time to, it takes, the dip is going to be immediate. And then as long as you take care of your payments on time from then on, slowly it'll come back up in the next year or year and a half. You will come back to the level you kind of left off where it was. But the key important point here is, as long as you are paying your credit card bills on time every month in full, you don't have to worry about your credit score. You'll have a great credit score.
Thank you so much for sharing those components of a credit score, Mr. Prasad. I'm really gonna put those into account later in my life when I open a credit card. So next, we're gonna welcome Mr. Harold Israel, who will be explaining all about identity theft.
Okay, thank you very much, Olivia, and thank you to Bridget and Raj for their terrific presentations. Now I'm going to talk about identity theft. There's two things to remember about identity theft before we really get started. First, you could do everything right and still have your identity stolen. That happens, for example, when someone steals all your identities from like a bank or a department store or other type of vendor. You did nothing wrong, but your identity still got stolen. The other type is when you involuntarily help an identity identity thief by responding to questions that turn out to be someone trying to steal your identity. For example, if you get an email asking for your password to your email account. Other thing to remember is identity theft can happen to anybody. A few years ago, my wife's identity got stolen. All of a sudden, all her credit card limits started getting reduced, and we had no idea why. And it turns out that someone with her exact same name was applying for credit cards using her name and address. It was only when we reached out to the credit reporting company and found out that the person had a different social security card number that we were able to clear the problems that this person can happen. So it really can happen to anybody. Picking up where Raj left off, he mentioned that credit reports are somebody's report card. That means the credit reporting companies assume all the information on your report card is correct. When your identity is stolen, that information is not correct. And so the credit card company or credit reporting agency does not know that. And so that's why it's so important, like Raj said, is to monitor your credit report. So what is your identity? Identity is your personal information, your social security card number, your date of birth, your mother's maiden name, account numbers to anything, whether they be credit cards or bank accounts, and passwords or PINs. So what is identity theft? That's when someone else hides and uses your identity to get credit to buy something. Your identity can be stolen in numerous different ways and used to create new accounts and incur bills that this thief is trying to get you to pay. But how does identity theft happen? A friend or relative or roommate finds your private data. In other words, they take a bill or statement that's left in the open and just gives out your information. The other is a professional thief who intercepts your private data when you make a purchase, such as when you buy gas with a credit card or you're taking money out of the money machine, or you're the victim of a major hack or security breach affecting millions of people, such as when a bank gets hacked or when a hotel chain gets hacked. So how do you avoid becoming a victim? First is only keep the debit cards and credit cards that you actually use on your actual person. Leave all the rest at home. Never carry your social security card, because if your wallet gets stolen and the person takes your social security card, that gives them an opportunity to cause you great harm by opening tons of accounts and getting a ton of information about you. Never share account numbers or passwords with anyone unless it's someone who really, really needs to know. And try not to write down any of your passwords. Keep them hidden in an online vault. So what's it mean to get hacked? It means that someone has gotten into your device, whether it be a phone, iPad, or laptop, and has taken your private data from it. Hackers can get into cookies and browser histories, steal private data that you might have used to make purchases on the internet. Um, Another way you get hacked is by phishing or farming. What is phishing? Phishing is an email that looks like it comes from somebody you know and asks you to reply with private information when in fact the email address is in disguise. A common example of this is, for example, if my email address was harold@gmail.com, I would be sending you an email, except the email would be harold at a bunch of characters.com. It looks like it's coming from me because my name is on the to line, but it's a completely fake address on the email line. What is phishing? Sometimes you will receive an email that seems to come from a company like PayPal or Venmo or bank, and they ask you to update your account or confirm your account information or to provide your passwords. You should never, ever respond to those emails. They're always fake. A real company would never ask their customers to provide private information in an email. And what is farming? Farming is when you are redirected to a fake website that will ask for your private data. So if you are trying to buy something on Amazon.com, it may say Amazon.com, but it doesn't really take you to Amazon. It takes you to a fake site. A way to avoid this is to never respond to the email. Instead, just go directly to Amazon.com and enter into your information. That way, you know what is coming next. You're communicating directly with Amazon. So how do you protect yourself against phishing and farming? First is never respond to an email or request by giving private data, like I mentioned. And if you get a call from somebody asking you for that information, hang up the phone and call back. Do not ask the person who called you to give a number to call back on, because they often will give you a fake phone number. Instead, if Chase Bank is someone from Chase Bank is on the line and you don't know it's from Chase Bank, hang up the phone and call Chase Bank and say, were you trying to call me? Second, like I mentioned, if you click on a link, never click on a link in an email. Go to private data, because it's an invitation for problems. So we've talked about ID theft by hacking you. What's a multi-victim fraud? That's when a fraudster hacks a company to steal the private information of those who have whose information has been properly provided. So what are some signs that your private data may have been stolen? First is mystery charges on your bank or credit card statement. It is very important that you check your credit card statement once you have a credit card or a bank statement. Make sure that you purchased everything. The old-fashioned way for people to do it is to save all of their paper receipts and check it against the bills. Today, a lot of people don't have paper receipts, but they get receipts emailed to them. Whatever you do, try and check it to have proof that you actually made the purchase, and if there's a mistake, to call the company. Another sign that your data may have been stolen is if you get a weird message. A store you never heard of sends you a thank you note for your business. They ask you to confirm a purchase. Chances are, if you've never heard of the store, then you didn't do it. You didn't make the purchase, and you should ignore that email. Again, traditionally, most people got their bank statements and other statements by the U.S. mail. And then, for example, you get a bank statement every single month. If you don't get your bank statement, then it's a clue that perhaps someone stole your mail. Today, again, not a lot of people get statements by mail, but if you do, even if you're getting an email statement for your phone bill, for example, you don't get that stuff for some reason. Next, and importantly, and this is again how we discovered an issue, is the collection notices or calls start to show up. When you do not pay your bills on time, not only does it impact your credit report, but a lot of times the company will hire somebody to try and collect the bill because you haven't paid it. Of course, if you never knew you had the bill in the first place, you couldn't pay it. And all of a sudden, you get a ton of phone calls demanding payment for things that you never bought. Going to my example, that was, again, another reason why we found out. All of a sudden, we got calls every single week from different companies saying we owed them money. And we had to explain, no, we did not owe them the money. It was a fraudulent charge. And the only way we could do this is to provide the last 4 digits of our Social Security card number, which of course you're never supposed to do in the ordinary course because you're giving people personal information. But in this case, it was the only way we could get out, make the person understand that we did not make the charge. So how do you protect your record? How do you protect your credit? First is to keep your records in a safe place. Second, like I mentioned before, is to check your bank account for unknown charges. And third, as Raj said, is to check your credit reports on a regular basis to make sure that all of the debts are yours. Another way to protect your credit is to avoid credit repair scams. Oftentimes, if you're not paying your bills, scammers will send you emails or make phone calls and say, let us help you repair your credit. Most of the time, they're just trying to take more money from you. You are much better off trying to fix it yourself by calling the companies. It takes a lot of time and effort, but that way you know you're not going to get hurt. So now that you've learned the importance of a good credit score, and sometimes, like I said, you do all the right things and you still have a low score or report, then what could be going on? First, there's a mistake in your credit report. And secondly, for example, a store made a mistake or there's identity theft. Lastly, if you discover a problem, act fast. Close accounts that have been hacked, change your email passwords and user codes, and contact a credit reporting company if the debt is not yours. Thank you.
Great. Thank you so much, Mr. Israel. I definitely think we all need to work on being a little bit more aware of how identity can impact us in the future. So now that we've concluded our 3 presentations, we're going to go ahead and move on to the Q&A portion of our event. So our first question comes from Cole. So Cole, you can go ahead and unmute your microphone now to ask your question.
Hi, I had a question about identity theft and what are some ways you can recover from a stolen identity? And are there any like companies or banks that would like protect far past like noticing that your identity has been stolen?
Well, thank you, Cole, for your question. Appreciate it. Repairing your credit takes time and effort, but you can do it. The most important thing is to close the accounts that you that got hacked or charged, and contacting the credit reporting companies so they know what's going on and they can investigate. They have to respond to you, and you go through their email websites and let them know that you had a problem and to work through it. Also to contact your credit card company. A feature of many credit card companies, to the second part of your question, is when they notice unusual activity, they will actually send you an email or a text message. Those are very helpful. On a couple of occasions, my credit card company texted me and said, did you make this charge? And almost every time the answer is yes, but once the answer was no, and therefore they shut down my credit card and sent me a new one via overnight mail.
Great question, Cole. Our next question comes from Andrew. So Andrew, you can go ahead and unmute your microphone to ask your question.
My question was actually answered by Rod. So, yeah.
Okay, yeah. So Andrew's question was just when should someone like start a credit card or open a credit card, and Raj kind of answered that. So you're able to open one by yourself when you turn 18, and if you want to do open one before then you obviously need to have a cosigner such as a parent. So now I'm just going to start reading off a few of our questions that our members had asked before the meeting. So the first one is, given that most of our information is online, are there any specific recommendations regarding social media in order to prevent identity theft? And this is definitely a topic that is at a lot of people's concern due to the amount of people that are using social media now and how much information that you share on social media.
Okay, I'll take the first crack at that. The first thing is to use the highest privacy settings that your Facebook account or whatever, Snapchat, Instagram, whatever social media you're using, put it on the highest priority. The second is be careful who you accept as friends. A lot of people, it's a big contest to see who has the most friends. But to really help yourself is to only accept friend requests from people you know, because that will reduce the chance of a problem with social media. The next one is kind of a weird one, but is when you put your birthday on your social media account, don't put your actual birth date on it. Change it by a day or two, because that way, if somebody steals it, they won't be able to use it effectively. When the company, for example, store checks your credit and they say your birth date is January 3rd and your birthday is January 4th, they'll reject the credit application. Another one is strong passwords. That is always helpful. And lastly is be careful what you share. Because a lot of the times the security questions that people ask, what's your dog's name, what's your mom's maiden name, where were you born, those questions are used as legitimate questions by people that issue credit to make sure you are who you say you are. And if all of that information is on your social media, for example, your dog's name, that makes it easier for somebody to steal your identity.
Sounds great. Thank you so much, Mr. Israel. So our next question could kind of be directed towards Mr. Prasad. So the question is, does outspending your credit card affect your credit? And why does good credit matter?
Those are very good questions. And, so first let me answer the first question, outspending your credit card. I would say, yes, outspending your credit card is not a good thing, obviously from two aspects. Like first one is whenever we talk about outspending, that means you are going above your credit limit. Credit limit is, when you get a credit card, the credit card company is going to say, for this card, you can go, a limit of say $500 or $1,000. And the moment you go above that, most of the credit card companies also charge a fee. I think it's called an overdraft fee. So you don't want to be paying, any kind of fees to credit card companies unnecessarily. So that's first thing that you should avoid. Second is it can also impact your credit score. I think we talked about that in the pie chart that we had. Is as long as you are keeping your spending to 20 to 30% of your credit limit in each of your cards, that will help you to get a much higher score. I mean, I understand there are times that we cannot limit to 30% because we have a huge expense today because, let's say you bought a laptop or, something else happened. You're driving a car and the car broke down, that you got to get it fixed and you had to pay it up from a credit card. That's fine, right? So once in a while, if you go above the limit, that's fine. But on a regular basis, try to manage the spending between the 20 to 30%. That will maximize your credit score. Now, let me talk about the second part of the question, which is why does good credit matter? Good credit matters a lot because that's going to, number one, having a good credit is going to help you to get good, help you to get anything that you want. Like, for example, mortgages, auto loans, employments. I mean, nowadays, pretty much all the companies, before they give someone a position, offer someone a position, they will check the credit report to see how financially responsible this person has been, right? So employment requires credit report, insurance companies require credit report or credit score. Um, so so that's one reason why you want to have good credit. And the second reason is, if you're applying for a car loan or a mortgage, the credit scores matter in terms of interest rate. And for those bigger purchases, let's say you're buying a $20,000 car, or you're buying a $100,000 or $200,000 in a house, any small increase in the interest rate will make a big difference in the monthly amount that you pay. For example, if you're buying a house, even a small, interest increase like a 0.125%, which you may think like 0.125 is small, but if you really do the math, it could work out to, let's say, $100 a month or $70 a month that you'd be paying over a period of 30 years because you had a little bit of a bad credit score that could impact the monthly payments that you're making over a period of 5 years, 10 years, 20 years, 30 years. So that's the main reason why you have to have a good credit score.
Great, thank you. And we have one more question directed towards you is, do you know the most common ways or reasons people commonly fall into bad credit, unfortunately? Do you know those?
Yeah, I mean, unfortunately, we see in this country, there are a lot of people who are getting into this bad credit. Number one, I would say, is people don't really understand the responsibilities of credit. I mean, that's the whole mission behind CARE, is teaching young adults like you all, to be responsible with your credit. When I say responsible, that means, don't treat credit as free money, right? Credit is something that you owe. Credit is something that the bank is giving you upfront, but you are supposed to be paying it back on time, every month, right? So as long as you take care of that, then you won't get into bad credit. The second scenario, you can get into bad creditors, like where Harold was talking about, where someone can steal your identity and get open new credit on your behalf. And that is something that you should avoid by looking at your credit report, let's say every 4 months, or if you have a app like Credit Karma, you can look at it anytime that you want. And also, the three credit bureaus, I think most of them offer something called a lock product. So you could log in there and lock your credit report. That means no one can pull your credit report even by mistake, unless you authorize them to pull the credit report. So let's say in my case, I have locked my credit report. So if I go apply for a credit card, they cannot get my credit report unless I go first and unlock my credit report and then go apply for the credit card. And then they pull the credit report, they get it, they make the decision. And once that transaction is done, I go back and lock it again, right? So if you take care of these things, then you will not fall into a bad credit scenario. It's very similar to how you can maintain a good GPA in your school, right? As long as you are study well and get good grades, then your GPA is going to be good. You don't have to worry about GPA. Just have to take care of your studies and the exams. So same concept in credit as well.
Great, thank you so much. Our last question is from Miles. So Miles, you can go ahead and unmute your microphone to ask it.
Hi, this question's for Bridget. For people looking to go into graduate school, like law school and medical school, what is the best plan for paying back undergraduate student loans?
Okay, so it sounds like your question is, if you're going to grad school, I would say it depends on if your plan is to immediately go into grad school or to take some time off. But I would say the number one thing to keep in mind, especially if you're in high school, is to basically try and take out the lowest amount of loans that you can while you're in college. And that's going to come in when you're looking at different acceptances from different colleges, because, you know, at some point you're going to get the award letter that we talked about before, and you're going to see how much each school is going to cost you. But I think if you know that you're going to graduate school, you want to make sure to take out the least amount of loans in college, because graduate school is expensive and you're most likely going to have to take out loans again in graduate school. And then the second tip would be to also keep the same thing in mind when you're applying to graduate programs. For example, for me, when I applied to law schools, they're extremely different offers from different law schools. For one school, I would have had to take out private loans, and that already was off-putting for me. But for the school I ended up picking, I didn't have to take out any private loans, and I actually right before I started law school, I made sure to apply to scholarships. When I was in the summers in between law schools, I applied to additional scholarships, and I was able to graduate without being six figures in debt. You know, a lot of times, especially people my age, you talk to them about their student loans and they have six-figure debt just from college and from law school. And a large part of that is they're not really mindful of the student loans that they take out. And then two, they kind of buy into this idea of, I'll be able to pay it back eventually, which I actually think is the wrong way. No matter what your future profession is, I don't think it's right to go into it thinking I can take out any amount of student loans and I'll be able to make so much money that I'll pay it back. I think it's much better to be conservative about the student loans that you take out. And that even helps you when you graduate, because that means that you can choose what you want to do and you don't have to take a certain job just to pay back your student loans. Because I also have friends who feel like they have to go work at certain places just so that they'll be able to afford their student loans. So I would say the way to like pay back your college loans is, you know, one, take out the lowest amount of loans that you can. Two, once again, the whole thing with taking federal over private loans. If you take out federal loans and try to stick to federal loans in college, they are much more, you know, they work with you much better than private loans, because some of them may not charge you interest while you're in grad school, or you don't have to make payments while you're in grad school. And this is with federal loans. Private loans don't work the same way. So that's why there's so much of an emphasis in the presentation on federal loans. So just making very smart decisions about which loans to take out. And then once you finish grad school, kind of also paying back your student loans a priority. So that means once you're finished with school and, you know, you're working and you're getting paid, you don't want to be making minimum payments, or you don't want to like just be cavalier about paying back your student loans. You want to continue living like a student and be very aggressive about paying back your student loans, just so that you can kind of finish that and focus on other financial goals and financial things that you want to take care of. But I think really just from talking to my friends right now, really being forward thinking as a high school student and as a college student really, really pays off and really, really helps you out when you get to the other side. And avoiding this thinking of, if I go to medical school or if I go to law school, that means that I have to have a ridiculous amount of student loans.
Thank you so much, Ms. Dege. So that will conclude our presentation for today. Here is the Credit Abuse Resistant Education's information. They're a great resource for you guys to check out in the future, or if you have any other questions that we didn't cover in today's presentation. But first, I would like to thank our panelists for joining us today. You guys all did a great job on your presentations, and I really enjoyed learning all about these 3 different topics. And then I would also like to thank our members for your great questions and participation today. After this event, you will be receiving an email that includes our post-event survey. So it'd be great if you guys could take that. And I will also attach the presentation PowerPoint that we used today for you guys to reference in the future. And lastly, I'd just like to announce that our next event is our Wharton Alumni Panel, which is taking place on September 2nd. So the Eventbrite will be out for that soon. So once again, thank you all so much for joining us today. I hope you learned a lot, and I hope you have a great rest of your weekend. Thank you so much, everyone.
Bye, guys.
Bye.
Thank you. Thank you for joining us for our CARE Financial Education panel. Our next event is our University of Pennsylvania Wharton Alumni Panel, which is taking place on Wednesday, September 2nd from 3 to 4 p.m. Central Standard Time. You can also learn more about the Junior Economic Club of Chicago at junioreconomicclub.org/home. Also, make sure to follow us on Instagram at JEC Chicago. Once again, thanks for joining us.